Welcome to the Pirate Investor. In this video, we will show you how to invest in the world's largest companies. There are many different ways to invest in the companies of the stock market. Each one has its advantages and disadvantages. Among them, the pirate chooses a way to invest that is simple, requires little time, and facilitates diversification. One way to invest that matches the pirate investor's requirements is investing through mutual funds, or through exchange-traded funds, also called ETFs. These investing products allow us to invest in a simple way, and with diversification. One fund invests in hundreds of stocks. It is much simpler and less time-consuming to put $100 in a fund than buying each individual stock separately. Mutual funds are collective investments. Many different investors put money together to be invested in different financial assets, like stocks. Mutual funds are managed by an underlying asset management company, and commercialized by brokers and banks. There are two kinds of funds: actively managed funds and index funds, also called passively managed. In actively managed funds, someone decides on which stocks to invest. But in index funds, however, they just invest in the stocks that compose their reference index, in the proportion indicated by the index. Since this requires little work, index funds' fees are much lower than those of actively managed funds. ETFs are funds that can be traded in an exchange or market, just like a stock. They are passively managed and replicate an index. Like index funds, they have low fees, but in this case, you also pay a fee when you buy or sell. Between actively managed funds and passively managed index funds, or ETFs, the pirate investor chooses index funds or ETFs because they are simpler, have lower fees, and offer a nice diversification. On top of that, long-term, less than 15% of managed funds beat the index performance. The pirate will focus on two famous indexes: MSCI World and SP500. The MSCI World is an index composed by more than 1,000 stocks of companies from 23 developed countries. At the moment, the main components are the biggest companies of the lead economy, the United States. The SP500 is an index composed by the largest 500 companies in the United States that comply the requirements to be part of it. Given that both are mainly composed by American companies, they perform similarly. We'll analyze it in other videos, but lately, and over long periods, SP500 had a better performance, because the biggest companies of the lead economy performed better than those in other countries. SP500 also has higher risk, because it focuses only in one country. For the pirate, both are good choices. In future videos, we will review and compare these indexes in detail, and find a good moment to invest. See you in the next episode.